Now, here's our big story. It's the first time in 11 months that consumer inflation has dropped. It's gone below 6%. November CPI now stands at 5.88%. What was the print in October? It was 6.77%. So yes, inflation has come down. This big drop we're seeing has come in from food prices. Inflation well below 5% in comparison with 7% in October when we consider food prices. So now the question is, will these numbers put the brakes on rate hikes? Will we go slower on rate hikes? That remains to be seen. Meanwhile, we've also had the October industrial output data. Now that data shows that industrial growth has slowed down to a negative 4%. So now it is at a 26-month low. Among the various perspectives that we've been getting this evening, as soon as that print came out, was our consulting editor at ET Now, Madhavi Arora, as well, to tell us about the significance, I should say, about these two prints that we've got, both on the inflation front and industrial production. This is what Maithili told us.
Well, this evening brought some good news as well as some bad for the government and the Reserve Bank of India. Consumer price inflation and retail inflation, which has been the bugbear of the Reserve Bank of India, came in at an 11-month low. But to compensate for that, we saw industrial production also drop to a 26-month low. So first, let me talk a little bit about the CPI, because that's the good news, that since January this year, inflation has always trended above 6%. So after January, inflation has finally come in at below 6%, which is the upper end of the RBI's inflation target range. Inflation for the month of November came in at 5.88%. Best of all, it was driven by food inflation, which has come in dramatically lower at 4.7%, vis-a-vis 7.01% in the previous month. Now to turn to the bad news, industrial production actually contract 4%. Worse was that manufacturing contracted by 5.6%. There was very little good news on the industrial production front, barring electricity, which grew very nominally by 1.2%. Mining contracted, manufacturing contracted, consumer durables as well as consumer non-durables also contracted and in double digits. So overall, some good news, some bad. Clearly, there's a great deal of work that still remains both for the RBI and the government.
Yes, on both sides, it seems work needs to be done. At least that's one view that's coming in. Let's get further perspective from Madhavi Arora. She's lead economist at Emkay Global, and she's joined by Garima Kapoor, the chief economist at Elara Capital. Thank you both for joining us this evening. Madhavi, coming to you first, looking at these numbers on industrial production, are you concerned about the growth front in the Indian economy, or do we still look good enough in light of the global headwinds?
So I think the IIP data is currently indicating the global manufacturing slowdown, which is reflecting in India via the export slowdown, which is leading the way at this point in time. Also, I think, because there were some holidays in October, that may also have marginally hurt the manufacturing activity in certain segments. But that said, I think if you see the recent PMI performances have been quite steady versus emerging market peers. But within that also, the exports are one segment which are indicating rapid weakness. So I think in the near term, exports are going to lead the slowdown in India, which is impending and probably will catch up for the rest of the world.
In the meantime, we're looking at the inflation numbers as well. Garima, would you celebrate the inflation print, or would you think it's too early? And will the RBI find solace in these numbers, perhaps go easier on rate hikes in times to come immediately?
Look, this 5.8, it is clearly heartening because my base case is also not below 6%. What is surprised is, of course, that beyond food, you've also seen the momentum of housing inflation being much lower than what seasonally it is in this particular month. Plus, remember, seasonally, food inflation always moderates. You see MOM decline in vegetables and fruits, as well as pulses and oilseeds, and that is yet to catch up. You will see the similar phenomena play out in the month of December as well, and probably in the month of January. Our channel checks in rural India suggest that the output is going to be quite buoyant, contrary to initial expectations that erratic monsoon has affected the output. That means you will see this print play out. But remember, you're more worrying about the core inflation prints, which are remaining sticky. Recent RBI policy has made it quite emphatically clear that they are worried about an elevated and sticky core inflation. So while it's time to feel good about the fact that your CPI is finally below 6%, I think some bit of it is already into seasonal, but it's more important that whether it sustains over next 3 months, and most importantly, whether your core inflation prints start to come off. There are no early signs of that happening yet.
Madhavi, do you think this could sustain? And of course, if India has to outperform its global peers, which are the sectors, because we're looking at the industrial production numbers as well, which are the sectors that will have to accelerate? And if policies you see as helping achieve some of those targets that are being set right now to kind of use the opportunity that global headwinds appear. And of course, as far as India is being talked about as a beacon, you will need more policies to help push that growth story.
Is it for me? Or for Garima?
I was asking you, Madhavi.
Yeah. So basically, at this point in time, at least, what we are seeing that the infra goods sector, if I see the IIP number today, has continued to outperform versus consumer and capital goods. And I think that segment also is getting a lot of policy push and probably would, lead the impetus. But otherwise, within the export share, which if the, the policymakers are intending to work towards keeping our export share intact, or at least not have a very material impact on growth in the medium term on the sectors. I think textiles, pharmaceuticals, electrical equipments, engineering goods, transportation, again, all of them have very large export share. And I think the policy focus should then be, managing those which probably would contain the fall in manufacturing activity ahead.
Right. And Garima, how much help is lower crude oil price, the prices that we're seeing right now, since they have gone down, and there is an expectation, talking to some experts, that it might go all the way down to $70 a barrel. This is going to have a significant difference, you think, on account of, in the months to come, the current account deficit that we've seen in terms of our import bill. Oil is pretty much high. Now, at this time, when you're looking at the inflation picture, how do you think lower crude oil prices are going to help in times to come?
Look, in most normal certain circumstances, it would have been a very positive news. Brent had close to 75, 20% down from recent October highs. But remember, your OMCs have not changed pump prices since July. So while they have, subsumed the losses while selling the selling the diesel and petrol below the international prices, now it is the time for them to recover those losses. So we do believe that if the prices sustain close to 75, for most part of the current month, they would break even and would also start to recover and post some nominal profits, post which I think it could be conducive for us to start seeing some reduction in petrol and diesel prices at the pump starting January. And that's when the real impact of the international crude price correction will start to reflect in our CPI. So I don't think it will reflect in December. I think some time to go for that.
Do you agree in terms of the current account deficit that has been growing in recent times? How much is it likely to throw future IIP prints under pressure? Is much of our export-oriented goods captured in the IIP print? And what's the role that crude oil prices are going to play going ahead now?
So we're looking at current account deficit, to remain elevated for the year, looking at around 3.5, 3.6% for the year, and for next year also moderating, but remaining, in the league of around 3%. I'm not looking at Brent really coming off dramatically in the coming year or so. I think it should be ranging between 90 to 100 kind of a level, which I don't think is very comfortable. But of course, doesn't at least incrementally, pressurize the current account deficit from the current level. But that said, I think overall the trade numbers have been hovering between 24 to 28 billion. I think in the next quarter, which is generally seasonally a very good quarter for trade numbers, should still remain elevated. And I'm expecting that even for March quarter, you should see current account, remaining seasonally high, and even trade deficit ranging somewhere close to 25 billion per month.
Thanks very much for joining us with your perspectives on this. Many of these stories as far as the factors that will determine the future line of inflation, industrial production. We're looking at current account deficit as well. All of these are moving pieces, and we'll continue to watch what the RBI does in doing the balancing act when it comes to growth and inflation. That is going to be a key area to watch. But thanks very much, Garima and Madhavi, for joining us on India Tonight.
Thank you.